Hi, my name is George Dagnino. I'm the editor and publisher of the Peter Dag Portfolio Strategy Management. By the way, some of you ask me, who's Peter Dag? Peter Dag is me. When I started this business in 1977, Dagnino sounded a little heavy. So I chopped the Nino off and I called it Dag. Then when I thought George Dag doesn't sound right, so I put some P and R's and T's to sound maybe a little snappier. So that's how Peter Dag came. I did all that, believe it or not, October 13, 1977, at around 11, 12 o'clock at night. So anyway, here I am. Now, what I want to talk to you about this video is something I thought of for a long, long time. And I'm getting paid to think out of the box, to think different. And one of the things that sort of I'm impressed and let's say bugs me is that every time you open the TV, a business channel, they only talk about the Fed and the Fed this and the Fed that. Man, they can do everything. They higher employment, lower employment, stronger economy, weaker economy. They raise interest rates. I mean, they talk about the Fed as if we're sort of a god with a lower G, controlling us every aspects of our life. It's all the Fed. So I said, wait a minute, what about business? What about the people who make decisions based on regulations, taxations, and environment and all that stuff? These people are, you know, where the where, where the tire hits the ground. Why are they ignored? So I started thinking the other way around. What if really the Fed doesn't matter? Now think about that. Just think about if they sold you just a bill of goods that really is not true. The Fed was, at least everything I read, the Fed's job is to make sure that the banks don't fall apart, which is what has happened in March with the banks in California. That's what they did. They put a lot of money and they saved the banks. So really, how do they how can they change our life? So this is the approach that I'm having. I'm just putting some other thoughts together. I know I talked about this in the past, but I just put more thoughts together, and let's see if I make sense to you. If I'm not, just please let me know. I'd like to learn from you. Okay, this the way I understand things work. Okay, the Federal Reserve protects or helps, manages, makes sure that things are okay in the banking system. That's where how they interact. No matter how you cut it, that's their action is through the banking system. Then there is the government with all the taxation, regulation, stimulus, industrial policy, and so on. The business interacts with the banking, with the government, and they have to try to survive. They have to try to make money. They try to meet consumer demands. As they try to adjust their production, of course, they impact the business cycle. Business goes up, it goes down, and as business goes up and declines, of course, you have rising interest rates, declining interest rates, more profit, less profit, and that's how markets react. You have more inflation, lower inflation, and so on. So this is the way I think the process is. Now, when the Federal Reserve raises interest rates, it raises interest or lowers interest rates. The way I understand, I probably misunderstood the whole thing, but when they raise interest rates or lower interest rates, they raise interest rates to discourage banks to lend, right? Because if you raise interest rates to the banks, the banks, that's where the juice comes from. They don't, since the money is more expensive, they don't discourage to lend. When the lower interest rates, they make the money cheaper, so the banks borrow from the Fed, and so they make more money when they lend. But eventually, whatever the Fed does, the banking system has to react with business. So let's say business made some bad decisions, okay? And inventories are too high, so they had to cut production and so on and so on. The banks are not so stupid. They're not going to lend to these people. It doesn't matter what the Fed is doing, because if the business is doing bad, they're not going to lend. So the Fed, what is the Fed going to do? It's the banking system that by lending or not lending to business creates money. Is the banks print money, not the Fed. It's through the lending activity of the banking system that these loans is the juice that flows through the business. Then, of course, there is the action of the government, like stimulus money, so business enjoys all this money and consumers buy, business booms, and so on. So this is, and when the government spends too much, then of course the consumers have too much money, they buy what business cannot produce, and therefore you have inflation. But all this is independent from this system here. The banking system lend or not lend, depending how they see business doing. Are they making money? Yes, so we're going to lend money. Are they not making money? Okay, we are not lending, so the money supply contracts. And this is independent from the Fed, what the Fed does. This is the way I understand it. And I looked at it for many, many years. But it's as simple as that. So the fact that people on TV, they always thought the Fed is doing out, therefore the higher interest rates, therefore business is going to. No, business is not doing anything, because it's the banking system that helps business, not the Fed. Let me show you what I mean a little with more detail. So the banks interact with business. So they know very well how business is doing and how consumers are doing. They have the pulse on the economy, day by day, every day. So there is a survey by the Federal Reserve, is a quarterly survey that asks the major banks, are you tightening lending standards or not? And then they computed percentage of banks tightening lending standards. So if the majority of banks are tightening lending standards, that means that the banks are seeing things going pretty badly out there. There is a lot of risk, so they are not lending money, or at least they're very careful in lending money. And this is the way the curve is. You can see here they increasing the number of banks increasing lending standard increased because they saw trouble ahead, and sure enough there was a recession. The same thing happened here, and sure enough there was a recession. The same thing happened here, and sure enough there was a recession. Look, when they started tightening lending, somewhere in 2021, they started raising lending standards, independently what the Fed is doing or not doing. The banks, and since then, actually, the money supply started slowing down. Why? Because they're lending less. So there's less juice in business. And this is totally independent of what, I mean, I want to say totally independent, but the action of the banks is much more important. The action of the bank on how they respond to the marketplace is much more important than what the Fed decides to do. So you saw in the previous slides that sometimes in 21, 22, the banks started raising lending standards because people were swamped with money. They spend it. Now what? Okay, what is left out there? So in what has happened, that they started slowing down lending because they saw that again a lot of banks were raising lending standards. The money supply declined, and because of bank credit slowed down quite sharply. So the banks are reacting to business. They are not reacting to the Federal Reserve. The Federal Reserve is trying to adapt to what the banks are seeing, the way I see it. The reason I'm saying what I'm saying, because I looked at this chart, what the evidence shows, that market interest rates start moving way ahead of the Federal Reserve. That's what this chart is showing. What the evidence shows that the 2-year, the short-term interest rates on Treasury notes moves ahead of the Federal Reserve. And the Federal Reserve, once they see market rates rising, what they do, they try to reflect market rates within the banking system so that the lending and borrowing from the Fed is neutral as far as the banks are concerned. This is what happens here. Look, see, this is since 1980. The red line is the 2-year. Always moves ahead of this. Look here, moved way ahead before the Fed started move. The dark line is the interest rates set by the Fed funds rate. This moves a year and a half before the Fed. The Fed eventually moved. Here the same thing. They move a year and a half ahead of the Fed. Eventually the Fed moved because they are trying to adjust to what the banks, what the markets are doing. The red line is the markets. The Fed, the dark line is the Fed. If they were the gods that the TV business channels are saying, they should move ahead of the red line in anticipation of. But this is history. I'm not. This is coming from for the Federal Reserve Bank of St. Louis, so I'm not cheating. Okay, so this is it. If the Fed was the people that the press says, the dark line should always turn ahead of the red line. Instead, it's the opposite all the time. I mean, this is 60 years of history. It's not just yesterday. So think about that. Of course, now that you think, but if the Fed doesn't count, what am I supposed to believe? But that's my point. That's my point. You have to think the way I think. You got to think different. They're just a big megaphone, but the king, you know, the guy, what do they say? The king doesn't have the dresses. There's walking naked, whatever. Okay, think about it. And in the current cycle, which started in 2020, the Fed has done, or at least they made us believe that they were tightening, but it really didn't matter. It didn't matter whatsoever of what they did. They didn't have any impact whatsoever. And by the way, I was wrong as many other people on this. Because as you can see here, the markets, this is interest rates on the short term. And this is near term. These are, let me see. This is the 2-year and this is Treasury bills. Interest rates went up all the way because the economy was strong. And the economy was strong because of the huge stimulus program by the Treasury. The Fed was totally impotent about this. Powerless, not impotent, powerless. The stimulus of the aggressive, this time money printing of the Treasury overwhelmed whatever the Fed was doing, despite the fact that the banks were not lending. So you have, quote unquote, the Fed tightening, raising interest rates to discourage the banks to lend. You have the banks not lending with raising lending standards, and they started before the Fed acted. But in the meantime, all that section was totally powerless because Treasury put so much money in circulation that the economy is so strong. So in fact now, it's in fact the fact that the markets are now overpowering the Fed, and as of recording today, which is the 10th, the yields are rising rapidly. The Fed is beginning to say we are done. It's the markets that are tightening. It's not the Fed. What are they going to do? The markets always take over. So now the Fed has become a spectator, which is what usually happens. I know this is crazy, but think about it. I'm here just to think different. I'm not trying to sound smart. So how do you know what is really going on? Well, I follow the ratio of the high yield bonds, junk bonds, and TLT, which is an ETF investing in treasuries, and HYG is an ETF investing in junk bonds. If the ratio goes up, means that people rather buy the junk bonds than the treasuries. So there is so much liquidity in the system injected by the Treasury, by the government, that investors prefer to buy high yield relative to treasuries. This is very dangerous. That's why interest rates are rising. It's not because the Fed is doing or what the banks are doing. We already know they're tightening lending standards. We already know they're not lending. But look at what the Fed is doing, what is the liquidity that there is in the system. This is why bond yields are rising. It's not what the Fed does, the tightening effect. If the Fed was effective, actually junk bonds, investor would prefer treasuries to junk bonds. So that means that the Fed not only was not followed always the market, but now is totally powerless compared to the action of the government and the treasuries. So you have to think really different now, really different. So what this chart is saying, there is a lot of liquidity in the system. Investors prefer junk bonds to treasuries. So with a lot of liquidity, business is going to be okay. But then what happens to inflation? That's what the problem is. That's what the problem is. So this is a tricky, you don't have to look at the Fed to understand how to invest your money right now. You have to look at what's happening out there. I believe that the answer to what the question is, what is really happening, can be found in looking at the business cycle. The business cycle reflects the decisions of thousands of businesses. All these businessmen making decisions because of what they see from the banks, they see from the Fed, they see regulations from the markets, from the consumers. This is the heart of what's going on. And the business cycle shows it's in 4 phases. The phase 1, business starts expanding. In the second phase, start growing. Business grows faster than the average growth. At some point here, interest rates, commodities, inflation start rising because business is overheating, is overspending, is overinvesting. Consumers are spending more than what they make. So the economy is overheating. And the sign the economy is overheating, that is, business is operating at a larger than what they can do, more than what they can do. So the strains are shown in the rising commodities, rising interest rates, and rising inflation. At this point, rising inflation is reducing the consumer purchasing power. So consumers start slowing down their purchases. Eventually, business recognizes that and start producing less or slowing down the production. And this is phase 3. In phase 4 is where everything is being corrected. The excesses of the business cycles are corrected. Interest rates are high. Banks are not lending. Lending standards are high. Inflation is rising. Consumers are tapped out. They cannot spend because they're not making any money after inflation. Commodities are rising, so cost for business is big. Unemployment rate is very low. So phase 4 is the correction part. This is where everything comes together and eventually the system normalizes again. Once that stage is reached, then business starts producing again, hiring again, more income, and the next business cycle starts. So the question is, okay, where are we now? Well, the Fed and the banking system have been in phase 4 for the last 2 years. They're raising lending standards. The Fed is raising interest rates to the banks, not to the consumers, to the banks. The banks are not lending. Credit is slowing down, it's contracting. The money supply is contracting. So The monetary system has been in phase 4, but because of this huge stimulus and huge deficit spending of the government, we have a lot of money, as I showed you with the high yield bonds. There's a lot of money out there. So consumers spent, the consumer purchased. So commodities and business had to produce. So there is a lot of, inflation and interest rates and commodities rising, because to produce goods, you got to buy raw materials. To produce goods, you have to borrow money, capital. You have to finance employment. You have to finance raw material. So you need capital to do that, working capital. So, and we are here because we see commodities still rising, interest rates is still rising, inflation maybe is declining. We have to see that. So this is what has to play out in the next several months. This slowdown in consumers, continued decline in inflation, continued decline in interest rates whenever that happens. But until that happens, we are in either phase 2 or phase 3, and there is no way. This is where the bottom of the stock market is usually. This is where the market does not much. And in fact, since 21, the stock market has not done anything because they see the uncertainties the same way the banks see the uncertainties. As I mentioned before, I'm the editor and publisher of the Peter Dack Portfolio Strategy and Management. If you go to this website here, you can get a free subscription, so you see all the things I write and how I think. I wrote this book because McGraw-Hill Education asked me to do it. They pay me to do it, so I was very pleased to accommodate that. This is the outcome, by the way, of a MBA course that I taught for many, many years. I wrote 2 more books, and of course you follow all the things that I record on video are on this address. And please do subscribe, because if you subscribe, it helps me to achieve some goals that I'm setting in my mind, like everybody else. Well, thank you very much for reviewing this video. I hope you find it useful. If not, let me know. Either way, if you subscribe to my channel, I would really appreciate it. Thank you so much, and see you very, very soon. Take care of yourself. Have a good day. Bye-bye.